Yeah, happy Monday to you, Jean-Guy. Hey, good morning, everybody. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Welcome to QuantBox Live, where we get our global macro on. We're going to get an update on all the markets. And by the way, Jay Powell spoke on 60 Minutes over the weekend and poo-pooed on the idea of cutting rates in March. So we'll take a look and see if there's any impact yet on and the Fed watch tool, if I can remember to do that. We'll also go through the scatter plot. We'll look at any changes in the gauges to spot underlying intrinsic trends developing. Maybe we'll take a look at some individual assets, but we're going to spend more time looking at the change in net cash flows, if you will, inside the market. Very cool. So, anyways, hey, if you're watching this on YouTube, you're watching it way, way, way delayed, many, 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 many hours delayed. So, hey, I know you like the pretty colors. I know you do. But would you like to organize your thoughts? Things you want to buy, things you want to try, things you want to avoid, or maybe set up for the future? Well, QuantBox does that. So, anyways, I got to show you this. You know what you're supposed to say? The two most important things: past performance does not predict future results, and don't risk money you cannot afford to lose. All right, cool, coolio, cool, cool, cool. We're getting closer and closer and closer, as you know, as I say every week, every day, that the AI alert surface is getting very, very close. For those that have signed up for this, you received the COT overview report done by the AI alert service. I just manually emailed it to those who subscribe. Did everybody get that? Yes? All right, good. All right, cool. Nice and clean, huh? Nice and easy. Really cool. So, anyways, we'll manually go over it, but I like to automate as much as possible. All right, so let's get on with it. Okay, and if you're interested in that alert service where you get text messages and emails when the AI spots important things, it prioritizes whether it should be an email or text. If you like that idea and you want to automate that economic research, then sign up because the price is going to go higher. $365, not $199. All right, back over the 4-0. Holy smokes. Well, we had FOMC on Wednesday and then non-farm payrolls on Friday, and things were way down, things are way up. Holy smokes, all over the place. And so, well, we're back above 4.0. That's a big deal. It's not like a huge deal, but we were comfortably below 4.0, and now we're not. So that is interesting. Currently, when I this just grabbed my eye. Currently, we're ever so bullish today. Oh, interesting. So we'll have to pay attention. Oil stabilizing, maybe. Okay. Oh, Boris says, "Hey, I also got the email about traders." Yeah, cool. You can't join yet. Just sign up for the email, and I'll let you know. I'll show that. I think I have that open. Yeah, I have it open. All right. So you got an email introducing. Well, like here's the thing: QuantBox only does fundamentals. I mean, it does technicals in the sense that it'll analyze the technical trend and then score it, but it's just looking at daily candles and analyzing, doing some simple trend analysis, right? It's not hardcore technical analysis. So, well, Traders is a new service I'm developing. I haven't launched it yet, and who knows, maybe it gets too expensive and I just don't explore it. But if your guy's into it, I can get this done. And what it only does is technical analysis. So QuantBox's greatest weakness is it can't do technical analysis, and then this service, it only does technical analysis, but it doesn't do fundamental. So it's kind of like left brain, right brain, left brain, right brain. So you got left brain, right brain, and well, AI doesn't do stuff like that very well. So these are all different AIs. And this one, what it'll do is it looks at, let's say, 8 different patterns of 5 different time frames on 100 different assets, and it just tells you the things with high probability. Now, based on past performance. Now, that doesn't predict future results, but it does. You can calculate if you saw a rising wedge on euro dollar 4-hour chart 27 times, and 22 times it the projection hit, let's say 50 pips, and the other 5 times it didn't. Well, then you can calculate, well, in the past it did this probability, right? So you can still measure the past. Doesn't predict future results, but now this AI can spot it, draw it, and then draw the projections out for you. And so you could ask traders to go say, hey, traders, I want to do a currency radar. So you pull up that Forex radar and you say, right now, I want you to find scalps, spots, swings, and carry trades that that have a greater than 70% chance of working today based on past performance. And it'll just go, boom, here's the 5 things. Whoa, what? Yeah. And here's the probabilities. So, anyways, so Boris, just pop your name in there and let me know you care. That's all it is right now. We're also going to, I have a couple other logo designs that have been made. And in the next few days, I'd like to get your feedback on which one we should use for our community. Cool. So, anyways, going back to this, we're going to look at the scatter plot next, but just notice that on the short run, just today, this morning, there's an ever so risk on. Okay, S&P 500, okay, was up on Friday, but futures are down. So, Bitcoin back above 43. Holy smokes, that's a little bit of risk on. So you can see that being calculated in here. So when we look at the risk gauges on 3 time frames, mixed. Okay. No intrinsic trend on the long term, slightly risk off short term, slightly risk, shorter term. So I guess we'd call this nothing long term, risk off medium term, risk on short term. And what does that tell you? Look out. Look out. Yeah, you look left, boom, the bus runs you over from the right. Yeah. Well, Tim says stay out. Well, yeah. Or you go investigate and say, well, which one is it? Is it either? Or when I see no intrinsic trend, I lean on cross pairs. So I might not do like euro dollar. So QuantBox is saying, look, on the daily evaluation, you might want to look like euro dollar long. On a weekly evaluation, it's like you want to do euro dollar short. That's where the confusion is, right? So the way I read this is, why don't you check out euro kiwi? Why don't you check out euro Aussie? Why don't you check out euro CAD and go do some relative strength? So really, that's what it means to me, not necessarily stay out. It just says there's no underlying trend, so go do some relative strength. Okay. All right. So, anyways, let me zoom in so you can see this a little better. Okay. Boy, we have some risk on here. I wonder if that's going to stay the same, right? I wonder if that's going to stay the same throughout the day. We're at key levels. Dow is already higher, high, higher, low. S&P 500, I think, is basically double top, and NASI's double top. So we'll see what comes of it today. Once again, I think the short-term big news is that Powell spoke on 60 Minutes over the weekend and said, no, it ain't going to happen. No cut in March. So he's said it twice now. So maybe the market will wake up and say, ooh, okay, we're too aggressive. and the stock market comes down for a few days. I'd like the stock market to fall, let's say 8%, but between now and the next Fed meeting. Okay, cool. Okay, so that might be an interesting change in sentiment today that we get. Now, at the close, we have earnings again, more earnings. So at the end of the day, that could be a factor. I don't think as big as Meta and Apple and Amazon were, but nonetheless. Mixed bag here. FTSE up, and nobody thinks QuantBox is like, no, it should be down. It's a -3. So QuantBox doesn't like FTSE, but FTSE's up today. QuantBox does moderately like S&P 500, moderately, let's say, likes Dow, likes DAX a whole lot better. Nazi's got a 6 on it, but is just basically break even. Yeah. Yeah, so like mixed bag, really mixed bag. Uh it seems like there's a skew to the right, but mm, yeah. So really no pattern yet. We're looking for like bearish, I mean bullish, expected to expected or unexpected to unexpected, and I don't really see it. It seems like it's sideways. We'd have to like maybe get rid of the indices, and then you'd have to get rid of commodities. Okay. And it starts to look still more sideways, huh? Like there's a little bit of everything everywhere. So once again, right now, and this is the market now. This is like right now. Um, there's no underlying trend, but like I said, to Tim's response of stay out, I'm like, well, it actually means crosses, right? So pound CAD, Euro Aussie, these types of things seem to be doing okay. Euro pound, Kiwi CAD, these are all crosses, right? Not Kiwi dollar, Kiwi CAD, Aussie CAD, okay? That kind of stuff. So non-funding pairs. Cool. All right. So the big one, the big one, sorry, the big one. Yeah, you know what? I'm going to take a day quill. I think it's one of those days. It was cold and rainy in Georgia. Rained all yesterday, and it went from warm on Friday to cold on Sunday. And I spent the day in my bubble day hubano. I don't know why it was warm in there, but I don't know. Nah, might need that day quill. I don't have time to get sick. All right. So here we are. Okay, heavily along the Japanese stock market. A lot of this might be an indication too of where the China money is going. Remember, the Chinese stock market is crashing. I mean, it is down, down, down. I once owned a Chinese ADR that just went out of business. You're like, whoa, that's low. So, anyways, where's the money going? Is it going to the United States? Could be. But China's on a 2-year tear. I'm wondering how much of that is Chinese money. Be interesting to find out. Okay. Some money coming out of SPX. Yeah, money coming out, profit taking, profit taking. So we've been going up, but the herd is thinning. The herd is thinning. Yeah. Yields are coming down, which is good on the 10-year. Platinum in the middle, silver in the middle, gold strong. Although, remember, I disagree with the market on this one. And some down for now is fine until we get to a narrative. And I think we'll get to this narrative eventually, that the Fed got us down to 3, but 2 ain't going to happen. And I think one reasonable scenario is that inflation sits, let's say, between 2.5 and 3.5, maybe even tickle 4 every once in a while, and we just do not get to target. Oops, there you guys are. Sorry. We just don't get to target in the next few years. And when we get to a narrative like that, in a good environment, meaning in a good economy where your house is going up in value and the stock market's up in value, but we, like we can live with 3%, but gold becomes more attractive when there's inflation. Right now we're in a disinflationary period, so I disagree with it, but this might be longer term institutional investors. Do I have the report? Let's see if I have the report that was emailed to me. Emailed. We got that on Friday, didn't we? Oh, I have so many emails since then. I think I can do a sort of my email. Friday, talking about Friday. Yeah, Friday 2-2. Yeah, all right. So let me just pop this. Pop it. Will it come on, Bubba? Pop it. All right. Cool. So this was Friday, 2 days ago. And I guess was yeah. So, anyways, this is what the new AI does. Isn't that nice? So net long, these are the important changes. Money went into the Japanese stock market and into the Dow and into the CAD. And okay, money came out of Aussie, money came out of yen. Okay. Rand, holy smokes. Okay. So that's nice. So you don't even have to log in when you get the AI alert services going, right? So very cool. So Japanese stock market benefited quite a bit. CAD caught a bid. Okay. Dow. See, isn't this nice? QuantBox did all this for you. Isn't that nice? Do, 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 do. Okay. Very cool. Dow. It's funny too how AI works, or I guess any machine. The way that you would do this and the way that I would do this is we'd sort it by net change and we'd look at it. Well, of course, it doesn't think that way, does it? It just goes, boom, here's the things. But it doesn't do it in order. Like, Ja- the Japanese stock market 4.2, but CAD over here, and then you're like, wait, and then down, right? And anyway, so you can see that it's not a human doing these, but uh humans take holidays, huh? Yeah, we don't have time for the holidays. So anyways, it's nice. All right. What else to money going into yeah, all this is middle run, a little bit of metals going on, a much smaller bid here on NASI. So it's still 2/3 long, 1/3 short. Okay. And it's just ever so bullish. But no bears is the thing. That's it. But remember, this is released on Friday and it's data from the Tuesday before Friday. So before the Fed meeting, before non-farm payrolls. So next or this Friday, you're going to want to do this report again and see how the market is adjusted since those two things. Cool though, right? I love the fact that you can see it's not just a net change, but like there were money went into the Dow. It's not right. You're right. Like new money went into the Dow. Not only did bulls buy the CAD, the bears left the market. Okay. So you can see week over week, 14% more bulls and 3% less bears. But then when you add up the contracts and all that, there's the difference, right? So now it's not just CAD went up and money went into CAD, but we can judge, well, why is it up? Is it more, is it less bears or is it more bulls? Well, both is great, but there's a difference whether people are entering a market or leaving a market, huh? Yeah. Money in versus money out. There's that Rand. Okay. Rand is back down to 50-50. So why does that happen? Well, if the Fed's not going to cut, then there's no reprieve for emerging markets that have dollar debt. They're going to pay 5.5% on their dollar debt. Okay. Mark says, can I ask if this data is a week old? What use is it to us? Longer term than the next 2 days. By the way, it's not old data. This is the newest data. It was released by the government on Friday, and this was updated no later than Saturday. Friday night it was updated, right? And then an alert was sent to us, AI alert subscribers. So this is the most useful information. But it's not just like for short-term traders, you only care about the next 2 hours. This shows you where the market is positioned. So, for example, the market is heavily long the Japanese stock market. Well, at some point, it's going to be too long, and the whole thing is going to come crashing down, in particular, if there's a monetary policy change by the Bank of Japan. You want to know that it's positioned long here. You want to know that rates are coming down right over here. This is the yield on the 10-year T-note. So you want to know where the market is positioned. I call that capital stock. Okay, where's the money? Okay, you can quantify how much money is in the pound, how much money is in platinum. Okay, but then we want to see the shift. So imagine, Mark, that some of these assets were shifting left to right. Well, I can tell you, SPX used to be over here, and now we're losing bulls. So when we look at the change, we want to see, are these moving left or right? And you can see this week over week through the net change. But in particular, why is it changing? It's the bulls versus bears. But are we adding bulls or are we losing bulls? Well, imagine over here on this Japanese stock market, we were only losing bulls. Okay. Okay. We were only losing bulls, but there were no bears. So you'd have probably modest technical analysis bearishness. It'd probably be forming a double top. And then at some point, you'll see that we are actually gaining bears now. See, in the first thing, prices coming down, but nobody's selling. People are just taking profit. But then the next wave down, there's a ton of people selling. Wow, that's going to be incredibly bearish versus moderately bearish. Okay. And that's the use, Mark. But think of it this way, maybe. You're going to see tops and bottoms of markets on the longer term. So you would know whether you should just be short-term short the Japanese stock market or long-term short. Are you going to, as a shorter term trader, as a day trader or a 4-hour trader, you might find that in the first wave, because you're just losing bulls, but there are no new bears, you might get a couple of day trades out of it. But later on, if we're actually attracting bears and the market's coming down, you can probably get a string of swing trades. Okay. Okay. Um, yeah. Porto says, can you consider including new currencies and indices in the futures? Indices, sure, but more currencies email me what you would suggest. Okay. And then you use a lot of lagging indicators. Well, economic analysis of past economics. Well, that is quantitative. You can't quantitate the stuff that hasn't happened. Some of it is right. So right, so we're going to have those lags, but the sentiment is like near real time. Like this is near real time, or we'll just call it real time. It is real time. Scatter plot real time. Okay. And that's where we're trying to connect what's happening today in the market. Because remember, there's a difference between the market and the economy. Okay. Now, if you're like, what more currencies are you like, emerging markets? Like one of the things I might add, remember, it just takes money and time. Right now, we have a lot of projects going on, a lot of upgrades going on right now. Um, so maybe I can add peso, but if you're like, um, Hungarian franc and stuff like that, I'm going to hesitate. Like, no, there's enough because all of this data you boil down to two things. Okay, all of this data, all these pages boil down to two things. Um, what's happening right now in the market? And why is the market behaving this way? Why is it risk on or risk off? Because of the market's perception of monetary policy. Those That's it. It's the only reason we do macroeconomics at all. You have to understand that. Like all the other pages, the million tables that we analyze get us to something like this. Um, I'll set this up for the Fed. So let me pull up the Fed's numbers. These are the Fed's projections for the future. So there's our leading indicator. But this isn't QuantBox quantifying anything. This is the Federal Reserve staff, the Board of Governors economic staff. This is the Fed's projections. So we know that that's that. And we want to see changes in this based on the new economic data coming in. So this is why we track all the economic. But if the economics are coming in as expected, then you would assume the policy, and this is policy down here, relative to their expectations. So we track all the other stuff to see is the economic data on the Fed's glide path. And then as that information comes in, we want to trade it because we're front running. The market is front running. They're thinking 6 months in ahead, right? And so there's this balance of what does the economic data present as far as the glide path of the Fed? And if they're right or if they're wrong, then the market's going to trade that and boom, boom, boom. And so we have all of that, right? So I don't think we need more. And here's the thing, if you understand risk on and risk off, and let's say you were trading Polish zloty, and you're like, Wayne, can you add millions of tables of price and time data and in historical trends for the Polish zloty? I'm like, no, there's not really demand for that. But if you're trading Polish zloty, you should understand its correlation with risk on or risk off assets, right? Okay. Custis says, yeah, Jay Powell's an interesting dude. Well, remember, I'll do the quick story here about Jay Powell. He's not an economist. So he was in private equity and his business wasn't in New York or it was actually in Washington, D.C. So he did private equity in D.C. his whole life and he retired a very wealthy person. Then he says, and I imagine he's sitting in his home office and he's drinking a scotch and smoking a cigar. He's like, what am I going to do with the rest of my life? And he says, I want to run the Fed. How do I do that? Right. So he went to a Washington think tank that was calculating the debt because at that point, the debt ceiling was a problem. This was like 15 years ago. And it was the time when Washington, D.C. was arguing about the debt ceiling seriously, and there was a government shutdown, right? So, anyways, so Jay Powell says, "Cool, that's my in." So the problem is nobody knew the day the Treasury would run out of money. It was an unknown number. So anyway, Powell goes to a nonprofit organization that's trying to figure that out. And he's like, "Hey, I'll work for you for free as an intern." They're like, "Really?" He's like, "Yeah, give me all the government databases," because this nonprofit was able to tap into all the different databases. So Jay Powell worked on it for, let's say, a year and figured it out, the date in which the government would run out of money. Cool. So then he went to Washington, D.C. No one would meet with them. So he started meeting with the junior people of congressmen and senators, um, and started telling them, "Hey, I figured it out. Here's when we'll run out of money. This is the actual debt ceiling and the day we'll hit it." And well, he started talking to people and they started talking to people. And all of a sudden, he was actually talking to real Congress people and real senators. So real representatives and real senators. Very cool. And he's like, so he, right? And he started going to the Republicans and he's like, this is exactly what you need. This is when they'll run out of money. And then he went to the Democrats. Here's exactly what you need in your negotiations. And this is the exact day. And then, of course, he'd meet with them and say, you're in the middle of a government shutdown. You're arguing over this. And he's like, if we get to this day, the government will have to release all the prisoners onto the streets, and retired people will stop receiving checks. And it scared the bejesus out of everybody. you know. Uh, so he got them to talk, negotiate, and then they settled on a debt ceiling. And the government shutdown was ended. Cool. Barack Obama, president at the time, said, "Oh my God, Jay Powell, that was amazing. You help us, solve that problem. Hey, I'm going to put you in the Fed." Now he's working at the Fed. And then yada, 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 yada. Boom! He runs the Fed. And you're like, dude, seriously, in about 8 years, he's running the Fed. From the time he's sitting there at his home office smoking a cigar, like, how do I play this? Dude, is he smart? It seems so. Yeah. You're like, oh my God, seriously. Yeah. Now he controls the world's economy. Not bad for, an 8-year plan. Just I mean, I think it was even less than 8 years. Like, oh my God. Yeah. So, anyways, there we go. I need to set up a special event. What are you guys doing on Wednesday? I might show you some upgrades that I've added. Oh, upgrades. Now we've been fixing a bajillion little bugs and tweaking a bunch of things, but there's some actual upgrades, and I believe they're ready. I looked at them over the weekend. I'm like, I think they're ready. Then I noticed one thing was kind of off, but we're there to start at least showing you these upgrades. Are you guys going to be around? Maybe I'll do a special webinar Wednesday, like 11 a.m. or noon or something like that. We can get people together, um, and I'll just show you. I have a super busy day. Always laugh. I have such a big week this week. I don't even know if I can get to that today. But I think it would be great to release that. So I'm pretty sure I have to meet with the developers. So see, I might have to do that tomorrow, and whatever. So yeah, definitely a maybe. Okay, I'm right. I don't want to delay it too long because it's done, I think. All right, cool. So cross pairs today, and by cross pairs, what I mean is you go into not dollar pairs, not yen pairs, these pairs. And so when you have sideways action, okay, you want to pay attention to these. If the dollar isn't going to move or the yen isn't going to move, smoothly, then you want to look in around here. Okay. Slightly bullish. You see, slightly bullish. Interest rate differential about the same, so that's neither here nor there. Inflation in Australia, okay, still over 4%, much lower in Europe. Okay, so all of that is all scored in here. And right now, COT data shows you institutional investors 64% long euro and 72% short Aussie. Oh God. Holy smokes, right? So if this has gone from a bearish undertone, which it's had, you can see January was bearish, to turning, you see how now we have above average price with a slight, right? Slight positive integer in our slope. Current projections that we should be on our way to 66, which is not a lot. 66 and a half is best case scenario, but that slope is likely to change if things become bullish today. So, like, once again, I'm not telling you to be bullish. I'm telling you to pay attention because it might be becoming bullish. Okay. And right now it's got a score of 5. And you want to run through all of these scenarios on the cross pairs. In particular, remember the message I'm trying to get to you. In particular, when there's no underlying intrinsic trend on dollar and yen pairs. When you looked at the gauges and they're mixed, don't just say there's no trade, just say there's no trend. And when there's no trend, you do relative strength and you want to look at these cross pairs. That's what they're there for. So you might say, like, pound CAD might not be something that you look at very often. Okay. And it's turning right? It's a 3 right now. If you look at the technical trend, this is down. Well, remember all that money that went into CAD? Huh? All that money that went into CAD, I showed you. This is why we use the COT report. Are you using it? Money went into CAD. There are people buying the Canadian dollar. Oh, pound CAD is down? Yeah, for sure. Okay. What about Aussie CAD? Yeah, look at the technical trend. Now, look at seasonality. This was up during the month of January, but by March, this asset typically falls. Well, it's already falling. Retail's heavily long. This dropped a couple of days ago. Okay. Dropped a couple of days ago below average negative trend. But remember, the COT report showed the money moved on Tuesday. So Friday, Thursday, Wednesday, right? And so here we go. As of that sort of previous week was all measured. And that's the flow right there. So the market got short in this period. Institutional investors got short. We're not looking at the price trend, we're calculating the number of contracts. So it's very factual and has maintained that bearishness. Oh, cool. So, right, it was up, but maybe is now rolling over, and we're getting pretty close to the time of year where that rolls over, anyways. So, this might be your thing. This is right. Going back to Mark's question, well, if it's such lagging data, why is it important to us? Because you can see what institutional investors are doing with their money, and maybe you can ride that wave. In this case, institutional investors are heavily selling Aussie and heavily buying CAD. Well, cool. You were alerted to this on Friday. And now you can look at this chart and say, oh, I see. I see why that's happening. Because institutional investors, my drawing tool's in the wrong spot. There we go. Institutional investors around here started buying the Canadian dollar. And now, a week later, Canadian dollar is down. Cool. And here's that window where we go from bullish to bearish. So you're like, oh, maybe it's an early move this year. Cool. Nice. So that's a giant maybe. So anyways, that's how you do fundamentals. Okay? That's quantitative analysis. Now we know why that asset is moving south. I can quantify it. Speaking about quantification, let's look at what's happened for the March meeting. Okay. Again, over the weekend, Jay Powell spoke on 60 Minutes and he said no March. Well, let's take a look. All right. 1 month ago, okay, 70% of the market said the Fed was going to cut in March. 1 week ago, 50% of the market said the Fed was going to cut in March. Okay. On Friday, right, 20% of the market said the Fed was going to cut in March. And now only 15% think the Fed's going to cut in March. And most likely, this is going to drop to below 10% today. And as I've taught at investorbootcamp.com, that's a shift to the right. Okay. And that typically brings USD up. Okay. Typically. So we'll see. And in that case, that probably means SPX down, the S&P 500 down. We'll see. But that's my, base case assumption. Now I have to confirm that by actually watching this, not just this shrink from 15 to 7, but I need to watch these markets, the stock market. So as I had mentioned before, just from memory, this is the higher low, higher high. So if I actually did this in the day trading group last night, where I'm like, if you're going to be a bull, you want to kick it off the 21 EMA. I own all of that, but I'm also hedged. So I'm concerned about the hedge. But if it collapses today, I'm hedged. If it doesn't, like I hedge down here, right? Like that's my problem. So if it's gonna rally again today, I'm just gonna capitulate, take the loss. I can take a small loss on a hedge because that's what hedges are. I thought it would go down and went up. I hedged. Um, So anyways, I have to do risk management, right? Oops, wrong one. Oh, don't. My camera's in the way. Let me relaunch that. Okay. My camera's in the way. There we go. I told you Dow had also made a higher high. Yep. Now, the amazing thing about this higher high is that in the Dow you have Boeing. Boeing is down 20%, and the Dow is still making all-time highs. There's only 30 stocks, and one of them is a negative 20. Holy schnicker. Somebody's overpriced, huh? So, anyways, that's a higher high. And then the NASI, it does not have a higher high. So, oh God. So today's going to be very interesting. On a weekly basis, 17,656 is the best selling price one would hope for. But it doesn't look terribly red. So I got to watch this very closely. Okay. Okay. Costa says, when the Fed is cutting interest rates, is that risk on or risk off? Let me ask you. Let's say, because we're talking about an interest rate, okay? Let's say you own a home and you have a mortgage. Cool. So I come to you and I'm like, hey, Costa, do you like your house? And you're like, yeah, it's great. Nice neighborhood. Cool. I want to give you a cheaper mortgage. How'd you like a 20% lower mortgage? I'll just give you the money and you pay me 20% less than you're paying now. Are you happy or not happy? Yeah, you're happy, of course. Cool. So now you have more disposable income. Okay. So now you have an extra $2,000 a month, an extra 2,000. You used to spend it on your mortgage. Now you have it. So you either save it or you spend it, right? Cool. That's risk on. You're like, I make an extra $25,000 a year. I can go on that vacation I like, or I can buy that TV, or I can pop that into my retirement account. But dude, yeah, remember savings. Okay, savings is equal to investment. Okay, so you could save it and it gets turned into investment. Okay, or you can consume it, and consumption is equal to something, but I can't remember. But you're going to consume it, save it, or invest it. Sweet. It's good for the economy. Okay. Now, if you think about, well, how does that impact the stock market? Well, every company in the S&P 500 borrows money. Just like you have a mortgage, they borrow money for cash flow. It's just normal. You have to. I mean, it's just required because you work on long-term projects that might not pay you every 2 weeks to pay your employees, or it may not pay off every month to pay the rent. Okay, so cash flow is always a problem. Maybe you're profitable, but cash flow is always a problem. So anyway, so the cost of doing business just got cheaper. Well, just like suddenly your disposable income went up, their disposable income went up. Except in a company, we don't call it disposable income, we call it profit. So nothing changed for the business, except now they're more profitable. Yeah, Jim's like, yeah, inventory. Inventory is classic. So you're selling shoes right now for the summer, but it's not even spring yet. So you got your winter shoes on sale. You have spring shoes that are arriving, and you're ordering summer shoes and stuff that could even go like back to school type shoes. You're ordering them now, and they're like, "Hey, that sounds good, Mister Shoe Salesman. That's $1 million for that inventory that you're going to be selling in September. We need that now. We'll send over the invoice." So then you go to the bank and you're like, "I need $1 million to buy shoes that I can sell in September." Okay, and there's a cost. So if that cost just went down, your profit margins went up. Okay. So, anyways, it's good. It's good. The only time is it's bad is when the economy is crashing. So the Fed typically is cutting interest rates when the economy is crashing and the dollar gets strong. But that's not what's happening now. And some people say the dollar gets strong because the Fed cuts interest rates. No, the dollar gets strong because the economy is crashing and therefore the Fed is cutting interest rates. So, anyways, um, gotta go. What a great day. I will see you later. Peace on earth. May the pips be with you. May your profits be above average. Cheers, mate. Ripper. Sharp, sharp.